Good afternoon, ladies and gentlemen, our beloved clients and followers, believers, fans, meron bang ganon, fans, fan club, mga suki, regulars, even the contractuals, early retirees, extended retirees, whether you're here and abroad, in whatever time zone, Eastern time zone, Western Daylight Saving time zone, hello. To sum up and to summarize, hello and welcome. Hello, and I'm sure it's not only me that you're looking for, but also this mid-year briefing. I can see it in your eyes and in your smile. Para bang kanta. Good afternoon. So to share with you our very constructive outlook, second half of this year, what's going to happen to the PSA? You may all be wondering, what's the journey going to be like? Is it going to be bumpy? Volatile again, boringly consistent range trading within the 6,300, 6,700 that we are unable to breach. You're so impatient na because nothing seems to be happening. So this is the briefing for you. First slide, please. This is our first slide, very vivid disclaimer. Okay. Proceed to the first slide. So to refresh your memory, this is the PSA to give you a nice perspective of what has happened in the past. We have 2 episodes here. So let me focus your attention to the arrows below, the light blue colored. Pandemic 2020-2022, you'll see the blue line rising. That's the PSA. And it's due to the reopening dividend. The PSA rose 31% to 7,500 early 2022. And that's because of the people are going out, the vaccination has reached its peak, and it's returned to normal. The virus has become endemic, and so it's celebration galore, revenge spending. But that was cut short. Killjoy talaga. The US Fed found out inflation is not transitory. They were erroneous in their reading of the inflation trajectory. It's supposed to be temporary, but it turned out it's more of like sticky and permanent. So they had to ramp up their hiking of the interest rate, Fed rate. And what happened to the dollar? The dollar soared and the peso weakened to 59. And there was too much uncertainty. There was panic. It seemed to be those who want to travel panicked because the dollar was like, wow, 59. And some were saying, oh, it's going to reach 68. One congressman was saying it's going to reach 68, adding fuel to the uncertainty. And so we had this deep correction, 23% correction in the PSA. And it's not because of the economy. It's really because of the Fed tightening. And then we had this inflation. We happened to have this inflation because oil was rising and food inflation was aggravated by the Ukraine war. And so it's this narrative. The next narrative after reopening was higher for longer. So this is where we are now. But as President Dumlao said, we seem to be in the cusp of a turning point, an inflection point, because this higher for longer cannot be sustained. It cannot be forever. Nothing lasts forever. And so the PSA rose 14% from this very low of 5,741. That was the time when the peso was like 59. And what supported the PSA? It was really the tightening and the stabilization of the currency. And we are now back to 54. Would you believe? Back to 54. And we are so lucky that our PSA continue to range trade despite the peak inflation of like 8.7% in January, and we have come down. We are down to 5.4%, and hopefully by July and August, we will see inflation print adjusting lower. And this is the turning point being referred to also by Dr. Abola. We are at inflection point. Ayan. So this is really the time to gear up, gearing for the upswing that our President Dumlao mentioned earlier, the upswing, the very much awaited upswing, maybe towards year end. Okay, next slide, please. Next slide, please. So this is where we are, very tight liquidity. And so the market is now awaiting the return of liquidity. This is the inflection point, the tipping point, the turning of the corner. Ano? Turning of the corner. Turning what? Turning around the corner. Turning the corner. I finally got it. Turning the corner. And our M3 money supply growth has subsided, decelerated to a low of 5.2%. And you'll see on your left excess liquidity. This is the SDA levels that the banks are keeping with the central bank. It's down also a little above 1.5 trillion, coming from a high of 2.5 trillion. So we're in a tight liquidity situation. Equities don't like that. Equities hate tight liquidity conditions. And so once all of these conditions reverse, then sentiment is going to improve. People will have some appetite. And it's not just ordinary people. These are the institutional investors. And of course, the much awaited return of the foreigners. Next slide, please. But look at the economy as already discussed by Dr. Abola. Look at the buoyancy and the resiliency of the Philippine economy. Philippine vehicle sales, 31% higher. Loan levels continue to perk up. Manufacturing continues to be on expansionary territory above 50. Anything above 50 is expansion. Anything below 50 is contraction. And you know the significance of this is that Philippine employment is 20%. Sorry, it's the reverse. 20% of Philippine unemployment is accounted for by the Philippine manufacturing sector. So this is good, and this is partly reflected in what Dr. Abola mentioned as the improvement in the unemployment rate to 4.3% coming from 4.5. So we're seeing buoyancy in the economy, which inspires us of the earnings capability, earnings growth capacity of our local corporates, and eventually benefiting the PISA. Next slide, please. I forgot loan levels also going up. And what is happening? What has happened? Local and foreign investors are sidelined. Look at the value traded lower. It has gone down to as low as like 1 billion pesos, excluding cross trades. And then not foreign selling. We're about 450 million US dollars, translated to 23 billion pesos year to date. And the foreign ownership of the PISA companies has gone down to like 20. Now, the latest I heard was 19% coming from 30%. So they're all out. The foreigners are out. They're all in the US. Next slide, please. So where did the money go? The money went to Wall Street. 36.1% is the rise year-to-date of NASDAQ, technology, the AI, the generative AI craze. And then S&P 500, 17.8%. Gold, which is a hedge against uncertainty, recession. There is this talk about recession, soft landing, hard landing, stagflation. And this is the major hedge. And people are diversifying. Okay, some are USD-based assets and then gold. And then emerging markets, it's 7.5% higher. And this is accounted for by the Latin American countries, which are producing mining products led by Brazil, Chile, Colombia. And last year, there was a huge demand for commodities. Metal prices have soared. And I think this is not going to last because there is this talk of recession. And then the US dollar, this is the tailwind for Philippine equities, the weakening dollar, negative 3.5% year to date. I'll show you the relationship, historical relationship between the dollar weakness and strength and the PISA. Okay, the Philippines is not lagging, contrary to the perception of many who are already bored with the consistent range of 6,003, 6,007, the PISA unable to breach 6,007. The Philippines is not lagging. We are just flat. Look at how worse Thailand is, 8.2% negative. Malaysia, negative 6.3. This is year-to-date performance in terms of total return. PISA is flat. And we are, like in terms of total return, we're already 1.2%. 1.2% total return, inclusive of dividends. And look at our FMIC model portfolio. The total return of our stock picks announced last January is now 4.3. Very much competitive with the GS, with the bond market, with the bond bond issuances, like the 4-year and the 2-year. Oh, not bad, 4.3. It may not be the 9.1% of the 10-year, but it's somewhere halfway, 4.3%. Next slide, please. Where did the money go? And these are the drivers that we are identifying will push the PISA higher. Look at the EPS revision. It's the black line. This is the consensus estimates of analysts of where PISA earnings are going to be onwards, 12-month forward. It's rising, but the PISA is insensitive. Look at the blue line. The PISA is hovering. This is the range trading mode, very insensitive because sentiment has not yet improved. And sentiment, investors are worried about the peaking of inflation. Is it going to be sustained lower, and will the central bank hike? Is the Fed going to hike in September? So these are some of the worries. And on your right, you will see the superiority of the earnings yield of the PISA companies, 7.2%. That is just the reverse of the 12 times PE that we are seeing now where we are. We're at 12 times PE, very cheap Philippine market versus the bond rate of 6.3, 10-year bond rate government, and yet to fall. This is going to fall in line with the inflation expectations and in line with the actual data and in line with the falling commodity prices. Global commodity prices are dropping. You'll be surprised. Oil, of course, we had this recent spike in the local pump prices, but oil prices now are almost, there was a time like a few weeks back when oil prices are even below the pre-Ukraine war, which was like 69. Recent days, we hit 69 for the WTI benchmark. The pre-Ukraine level was like 72, 74. So this is one tailwind for our PISA, the superiority of the earnings yield of the PISA companies versus the falling bond yields. Next slide, please. So this is a representation of the relationship of the how good an indicator is this peso dollar rate. You'll see that whenever the red line rise, the PISA suffers. And that was last year. You'll see the peak of the red line that was 59 pesos on the dollar, the exchange rate. And you see where did we go? 5,700. Where did the PISA go? 5,700. And now that the dollar is weakening, this would be some sort of a catalyst. Maybe not yet now, but if sustained, this is going to improve sentiment towards a Philippine market. Next slide, please. Foreign investors diversification. Why will the foreigners return and why will they diversify to the emerging markets? Right now, the US market is very frothy. There is this bandwagon, a lot of investments going into AI, the transformative power of generative artificial intelligence. But how long will it last if the broader economy is weakening? So there is now growing caution versus US equity. It is unsustainable, the very frothy movement, S&P 500 doing at 20 times PE and the NASDAQ doing at a higher 36 times PE. I'll show you later. And look at the earnings. Where's the earnings going? The earnings trajectory, the broken line, it's going down. Compare that with the PISA. The PISA is sluggish, range bound, but look at the earnings trajectory, it's higher. So all of these gaps must correct. The PISA is due for an alignment. So this is the inflection point and the time to accumulate because the big catalysts are coming soon. It's like a movie film. It's like coming soon. The now showing and then it's coming soon. All of these catalysts, maybe first quarter of 2024. I'll discuss that later. Next slide, please. Look at the valuation. So aside from the gaps that ought to be plugged, there is this wide dispersion in the valuation. NASDAQ is 36, S&P is 20. This is in terms of the PE. Emerging markets and PISA, both aligned at 12 times. Given our sound fundamentals, earnings trajectory, and other factors working in our favor, there must be a correction in terms of all of this overvaluation and undervaluation. We ought to be moving to where we are based on our fundamentals. And the foreigners are going to notice that because the US is going to might be slowing down. Earnings actually is already in recession. They're suffering from an earnings recession, and the equities market in Wall Street is in denial. The fourth quarter earnings in Wall Street is negative 7%. First quarter, that was fourth quarter earnings, 2022. First quarter earnings, second quarter earnings, 2023 is negative 5, and second quarter is expected to be negative. But for the AI tech-related companies, it's a different story. And so the question is, will this very small breath of rally persist given the broadening weakness of the US economy? The answer to that remains to be seen, but based on what has been the history, it cannot sustain. That cannot sustain in the face of broadening weakness in the US economy. Next slide, please. This is the inflection point and the tipping point, and the much-awaited correction of the inflation from a peak of 8.7, we are now in the journey towards 2% to 4%, which is the target of the central bank. Hopefully, there doesn't seem to be, nothing happens in terms of the weather, climate change, and the escalation of the war in Ukraine that can cause further hikes in oil. China is weak right now, and that is keeping the price of oil is still manageable, but OPEC is hot in further cutting and reaching the target price of like $80 to $90 per barrel. So this is the turning point. The BSP has paused, the US Fed has paused. So what's going to happen next? This is the buying opportunity. This is the buying window to position for the turn in the inflation cycle and in the interest rate cycle, both here and abroad. Next slide, please. So remember the triple B we mentioned, that investors should be like bracing for increased volatility, must be vigilant, and must do value hunting. And true enough, in the first 5-6 months of this year, the companies that have gained the most include those with low leverage, low volatility, has value, and high momentum. So these are just the names. Next slide, please. So in terms of our stock filters, we are inclined to recommend balance sheet strength, companies that have balance sheet strength, liquidity, and low debt, because in the US, actually, there's already talk that there could be a default cycle starting to pick up, and most managers doing bankruptcy cases are preparing for more business. Hopefully in the Philippines, the NPL ratios of the banks have not inched up significantly, is still within and below 3%. So we also like companies that have low volatility, defensive, and the dividend growers able to sustain their dividend policies given their good cash flows. And also those with value, this is the risk-averse approach to investing, because we do not want to catch a falling knife. We do not want to chase the rally. We want to be like having a margin of safety, buying at the very low, although it is so hard to catch the bottom. It's hard to do that. But we look at the PE and we compare that with the worst of the 2020 levels, pandemic levels. We also want to participate in companies with strong profitability, the regular catalyst for share prices, your margin, your ROE, pricing power, and market share dominance. Next slide, please. So in terms of the historical analogies, why do we believe there's going to be a rally? If you're going to look at the crisis year, 2001, when the US GDP shrunk, you'll see that investors were already slowly picking up stocks, even during the recession. And upon the affirmation of the recession, the market was already on top, already toppish. So it's best to be prepared, pick up your favorite stocks, do your homework now, and be able to reap the benefits of a rally ahead of the recovery of the economy. Next slide, please. In 2008, we see the same thing. Even 9 months before the recession was affirmed by the print inflation, by the economic data, there was already a rally. And the good news is that when Wall Street rallies, the Philippine market also rallies. Next slide, please. So what are the some of the criteria and historical evidence of foreign funds doing increased allocation to emerging markets? The latest Asia, this is the big news, the latest big news, and evidenced by the recent accumulation of fund managers. We had the buying of like 700 million pesos recently, and the latest Asian fund managers survey, these are Asian fund managers, about 500 of them managing some 750 billion US dollars in assets, are now saying that they are reducing their underweight position in the Philippines, and they are mildly overweighting the Philippines. I just hope it translates into action, and it is not just talk, but there are strong support to believe that we could be in for a nice surprise, because we have the economic growth to speak of, 6%. We have the earnings growth, which we predict is going to be like double-digit, 14%, very decent. And our valuation is cheap, undemanding, and very reasonable, 12 times PE. How low do you want us to go before these foreigners come in? 5 times PE? Is it going to be a throwback to the pandemic before they come in? Our liquidity is going to be returning as soon as inflation hits the target. The UBSP governor is saying that there's nothing, no option to take. The optionality is that rates are going to be cut once inflation becomes sustainable at the target levels. And then the dollar is already weakening, negative 3%. Our peso is 54. Hopefully it stays within the range of like 54, 55. And then the historical analogies that I have mentioned. Let's see, let's look back. The next slide will show you what were the conditions prevailing during the entry of foreign buying. So there were 5 years. In 2007, we saw foreign buying of 1.8 billion. In 2012, 2.4 billion. In 2015, 1.3 billion. So these are the green arrows I'm just reading. And then 1.1 billion in 2017, 782 million again in 2019, the last foreign buying year. So what were the conditions? The Philippine economy was showing growth of 7%, 6%. Inflation was within target, 2.9%, 1.8, 2.9. So there could be a possible repeat of the foreigners, which are all in the red. The red bars are the rolling 12-month net foreign stock investment. There could be a repeat of this cycle if and when inflation returns to the target of like 2 to 3%. And our GDP, as predicted by Dr. Abola, will even accelerate next year to 6.5. He is predicting 5.6% second quarter, and 6% for the whole year, but this is going to accelerate. So all the conditions in the past, which were the requisite conditions for the return of foreigners, might actually be coming into motion next year. And therefore, this is really the time to gear up for the upswing. Next slide, please. Okay, so this is our forecast for the PSEI, 7,003 to 7,500, EPS growth of 15% and PE of 13 to 14. So the difference between now and the forecast we made early in the year is the lower band of 7,003. And that is just to discount some of the uncertainties in the horizon, which includes sticky inflation, growth slowdown, and everything that we can blame for eventually. I have listed that in the last slide. The things to blame for if the PSEI don't reach 7.5. Next slide, please. So this is all anchored on the premise of lower inflation, interest rate cycle reversing, and liquidity getting back to the market, plus the upside from the foreigners returning, providing some overshoot for the market. We also like to have some secular themes overlay on top of our screening. So these are the mega trends. Infrastructure. Companies that are in the infrastructure space, we like them very much. They're going to be big recipients of growth. Hard and soft. Of course, I like the hard part. The hard would be you are all green-minded. The hard part will be the bridges, the railway, the airport, the Bulacan Airport, the NAIA rehab, the NAIA redevelopment, and the soft would be the digital side. So we have the digital economy, e-commerce, AI, and fintech. We will also have AI because we are having all of these telco companies doing their initiatives in e-wallets, very preliminary, not as advanced in the US. We don't have the names of NVIDIA and FANG, but eventually we will have some proxies. And I think you should have some stocks in this telco space so you're able to benefit from the, if and when the foreigners do look for some proxies of AI in the Philippines. We like companies that are into the renewable energy space, wind, solar, and geothermal, because eventually they have to comply with the 40% share of renewable power generation versus their totals. And then we like green metals. Green metals are those needed for batteries of electric vehicles. And they include nickel. And you can almost guess what is our favorite stock in the mining space, because you just have to add sulfur to this NPI, nickel pig iron, and then it becomes nickel matte, and that is the most important input, plus lithium, of course, to your electric vehicle. And we're seeing the boom in Tesla. Look at the Tesla shares and the overall demand for electric vehicle. Next slide, please. Okay, these are our stock picks and our bets on the teams, on the companies that are going to benefit from the evolving teams and evolving environment we're in. The foreigners are going to be buying the large cap and the mid cap stocks, SM, GT Cap, AEB, AC, LTG, and GT Cap is going to be the next big infrastructure play because you know there's this tender offer. Yes. And then the telcos, as I have said earlier, the AI, the potential AI proxies. And then property. Property is going to benefit from the easing of borrowing costs. They will be able to continue their development projects. And the REITs, as mentioned by Sir Dan. And the REITs are going to benefit. They're all below the IPO prices. The REIT, and they're the biggest casualties of this rate hiking cycle. And they will be making a big return as interest rates fall. And then we also like consumer discretionary. The JFC, of course, expanding globally. And tourism benefiting Bloom. Our tourist arrival has reached 2.7 million, would you believe? Our peak was like 8 million. We're still far, but it's already above the target of 1.4 million arrivals. And this is benefiting the hospitality industries. Wilcon, we like Wilcon because of the infra ventures. And then Monde has gone past the restructuring, the hard part. And the brands are really market leaders. And of course, DNL expanding in Europe and globally. Power and energy, those in the energy transition, we like AP, Meralco, and ASET. They have their carbon footprint plans and their investment in battery. All of them have investments in battery and maybe nuclear Meralco, modular nuclear reactors. And then mining, we have nickel and Apex involved in gold. And then banking, of course, we included UBP, the top big franchises benefiting from the still elevated interest rates, NIM expansion, and lending upcycle. Next slide, please. So what do we blame if the PSAID don't reach 7,500? It's El Nino. It's because of El Nino. Higher than expected Fed rates, GDP undershooting, renewed political tension, deeper than expected global recession, higher peso volatility. So when you do this trade and gear up in the second half for the upswing next year, please do all your trade for the multi-award with the multi-awarded broker, the best broker in town, First Metro Securities, multi-awarded. And always read their excellent researches. And of course, don't forget the products of our asset management company. We have all the product offerings if you're into bond funds, if you want to combine, if you want to bet on both the bonds and equity, bet on the relationship of the two, which has become positive. The offerings are all in FAMI. They have this consumer fund, they have this bond funds, dollar and peso, money market fund, SALBAC and SALI, the balance fund and the fixed income fund, SALFIF. Okay, I am done. I think that's it. Maraming salamat po so much. Thank you and good luck.
Thank you very much, Christy. Thank you for the plug. Again, there you have it, much awaited stock recommendations and their drivers. If I get that correctly, you had a whole mouthful, but let me just repeat some key takeaways. Stay vigilant, find values, those that have low leverage, low volatility, risk averse, and have cyclical profitability, market share, and margins. It's very calculating, not a time to be quite adventurous. And like you said, in case of doubt, we have our professional fund managers to do all the work for you. So you can also invest in the country's only locally issued ETF, the First Metro Philippine Exchange Traded Fund, which you can access through the First Metro Securities Brokerage online platform for secondary trading, or for primary issuances, you can reach out to First Metro Asset Management at fami.com.ph. Makikiplug na rin ako, di ba, Christy? Okay. Let's see what your responses are to the poll number 2. Are you actually going to be any different from Christie's forecast of 7,300 to 7,500 by year end? Okay, out of about, we have about 500 participants. 431 participants. 62% say it will go up. Wonderful. So that's from 6,500 level. You're saying that it will go up by year end. 8% minorities say it's going to go down. Okay. And 30% says that it will stay where it is. All right. So now we will hold on to what your forecasts are and whether you share in the belief of what Christy had just said. Okay. Before we start, what happened there? Okay. Before we start our formal panel, I think we'd like to give Christy a little bit more solo question Q&A. Okay. Christy, here we go. Ready? This is a long question. Monetary policy is likely to remain tight for the rest of the year as BSP expects inflation to go down below its 2 to 4 target. Given this, how do you think we should position our portfolio for the next 12 months? We should just hire you as a portfolio manager given your model portfolio, right? Are you favoring accumulating both fixed income and equities? But with equities market remaining flat year to date, what are the signals to investors to start returning to the stock market? Ang daming tanong. Are you favoring accumulating both fixed income and equities? And what are the signals to investors to start returning to the stock market?
Okay, signals muna. Signals, return. Foreign buying, watch out for evidence of foreign buying. And always be in the news, in the know. And the recent good news is that there is this BOFA report, it's the Bank of America report, saying that the Philippines is now being considered as a mild overweight, reducing the underweight position. So they're looking at us, the foreigners are looking at us. So watch out for the sustainability of foreign buying. And then second, watch out for inflation. Inflation is predicted to be like going down to 4% by October. If it does not happen, then you don't accumulate so much big because there could be a correction. It's going to be a disappointment. But if inflation sustains to like 4%, 3%, then we'll have a Santa Claus rally by year end. That's the happy thing by year end. So watch out for inflation. So it's foreign buying and inflation. And then of course, what the central bank is saying. whether they're hawkish and whether they're dovish. So always read in between the lines and try to get the expert's interpretation of what the BSP communication is. So always look for the macro, be the expert in the macro news. And then when it comes to the combination of bonds and equities, you are actually not betting on equities and bonds. You are betting on the relationship of the bonds and equities, because in the past, the relationship has been negative. When the equities market go up, it means you have growth. And when you have growth, the bond market doesn't like that. Bonds like recession. That's why that is the condition that bonds thrive. But for the first time in history, that relationship has been broken, because the bonds now, the interest rates are rising, and yet you have this AI euphoria in the US and equities are rallying. Interest rates are rising. There are losses in the bond market. But eventually, we are seeing now in the Philippines, what we're seeing is that the yields are high. The equities market is just stable. It's not crashing. It's not going back to 5,007 or 4,600. We are actually the most flat in Asia. Thailand is negative 10%. Malaysia is negative 6%. Indonesia is up, yes, because their inflation is already 2%. And Vietnam is up also because their inflation is already 2%. If we reach 2% inflation, we should be definitely going up in terms of our year-to-date gains. So it's inflation, and then it's foreign buying. It's what the central bank is saying. And the positioning in terms of the bond and equities is that you have to lock in long, because these are very good rates, 6.5% for the 10-year, 6.3%. We have not seen this for quite a long time, 6.3%. And if interest rates are going to fall down, lock in long, 2 years, 3 years, or maybe 10 if you can afford 10-year government bonds. And spice that up with the fact that equities are going to be going up. And so you will have the best of both worlds, because you are able to lock in long for your fixed income, for your regular cash flow, your coupon payments, and you're able to capitalize also on the cheap valuation now, and then reaping the return eventually over a 12-month period. And you will also have on your bond side some capital appreciation, because rates are going to fall down and the bond values are going to be rising. And so you have the benefit of like very high coupon payments and an ability to liquidate if the interest rates go down and bond values improve. And you have also the upside for equity. So this is really a sweet spot time to really bet on the combination of bond and equities. I think that's the strategy.
That's great. That's great to hear. Christy, okay, I just want to touch up on the point that you said about the point on foreign buying. Okay, you said watch out for foreign buying. What factors will bring them back then?
I have the slide already mentioning what MSCI has pointed out to be the historical drivers of increased allocation by foreigners into emerging market. So you please look at the Philippines within the context of the emerging markets. Right now, the big negative for emerging market is really the China slowdown. China has not performed up to par with respect to economic growth. The second quarter GDP was like a big disappointment, negative 0.8%. The year-on-year was 7%, and yet foreigners were not pleased with the, and now JP Morgan and Goldman Sachs have cut the economic growth forecast for China. So that's the big drag now. But there is a flip side to that, because China is going to be likely embarking on increased policy support to stimulate the economy, because they cannot afford like the current administration, the Communist Party cannot afford to be seen as a weak in this time of geopolitical tension. They have to, like, there's a lot of youth unemployment in China, and they are going to be forced to really embark big time as far as policy support is concerned. So they have to keep the economy rolling. But that, I think, is the big upside and a catalyst for emerging market. As soon as information comes out that the monetary authorities are going to be supporting the property market, because the property market is in a mess in China. If they're increasing, if they're lowering their medium-term lending facility, cutting bank reserves, then that's going to be good for the market and good for the entire emerging market. So that's one negative now. It's going to turn around. And then, of course, secondly, the dollar. The dollar has been a good predictor of the emerging market. MSCI has pointed out that if the dollar weakens and emerging market currencies improve, it's a come on in as far as increased allocation for emerging market. Aside from that, improving business condition is another one. Business condition has to improve and has to emerge from the very tight credit conditions. It's been very difficult now because interest rates are higher and it's been very hard for companies to float bonds at these very high rates. And so third would be improvement in business condition, and of course the interest rate and inflation cycle. That needs to happen. The return to 2 to 4% and the BSP cutting the rates. I think these are all the big catalysts that would encourage foreigners to come in here and consider the growth trajectory, which until now is very much underappreciated. We are 6%. We are the fastest in Asia, but we are underappreciated. Singapore is just doing 1%, Indonesia 4%. Vietnam is, yes, high as India also. And they're getting a slice of the action in terms of the total return. Very good performances of this market, India and Vietnam. And that's really because inflation there is low. In Vietnam, it's lower. And the policy cycle has gone down to, has actually adjusted to the normal levels. In Thailand, the inflation is low. But the problem in Thailand is that growth is also low. That's the problem there. But we have the benefit of strong economic growth. We're just waiting for inflation to come down and for the BSP to reverse. So let's all be patient.
Okay. All right. That's a lot of information, Christy. Thank you very much. I hope, many of our viewers, listeners got that.